If you're curious about mortgage interest rates, what makes them go up and down, and when you can expect the next drop or increase in interest rates, you'll want to watch this video. Hi, my name is David J. Moore, team leader of David J. Moore & Associates Real Estate Team. And today, I have two of the area's best and most experienced mortgage lenders, Andrew Domchik with First Home Mortgage and Anthony Sauce with Sandy Spring Bank. Andrew, can you tell us a little bit about yourself and how long you've been a full-time mortgage worker?
I've been a full-time mortgage lender for 30 plus years. I started in August of 1993, and I've been with pretty much the same company the entire time. There was some buyouts here and there, but
sure. So you've had a lot of experience with interest rates going up and down in different types of real estate markets.
There's nothing I haven't seen, but this market is very unique.
Okay.
Very unique right now.
All right. Anthony, can you tell us a little bit about yourself and how long you've been a mortgage lender?
Well, I've been the same as Andrew. I've been in the business over 30 years as well. And I started out with a couple companies for an extended period of time. Then I went into the banking side. And unfortunately, every time I go to work for a bank, it seems like I want to get bought out. But this bank has been around since 1800, so I feel pretty confident.
Feel pretty safe there?
Yeah.
So, I mean, that's a long time. So you both have got, what, over 60 years experience in mortgage lending. So
yeah.
You've seen a lot of ups, downs, sideways markets, interest rates going up and down.
Yes.
Yeah.
Oh, yes.
Absolutely.
Nothing we haven't seen.
Yeah, I mean, I've only been licensed since 2005, so I've seen some crazy markets. Grew up in a real estate market when nobody could get financing, tons of foreclosures, but it seems like you guys have a full decade or more
Oh, yeah.
than I do.
Yeah.
So thank you. And I do want to date this video. It is February 2024 that we're recording this video and discussing mortgage interest rates. And really we're doing so because for the last couple of years, it's really been a hot topic with buyers. And I think some of the news media lately has been leading buyers and sellers to believe that there is an interest rate reduction coming soon after a couple of years of rates going up. And really, I just have some general questions for the two of you about mortgage interest rates. We don't want to get too specific because if someone watches this video next year or 5 years from now, we want all the information that we're sharing to still be true and accurate. So we're just going to speak in general terms as far as how interest rates work, what influences them, and what buyers can expect really in any type of real estate market that they're in the Federal Reserve or whoever is doing whatever with the interest rates. So the first question I have for the two of you is, let's talk a little bit about interest rates for mortgages, how they're set and were determined. It seems a lot of people think that the Federal Reserve does this for people, and what they do has an immediate impact on the mortgage rates. Can you share with us a little bit about how mortgage rates are actually set and what influences them?
I'll go first. So interest rates are set by the sale of mortgage-backed securities. That's really what it's all about. Mortgage-backed securities are influenced by many factors. I mean, the Federal Reserve is one factor. There's all these reports, consumer pricing, producer pricing, on and on and on. The Feds do not have any control over mortgage interest rates. They have the control over the Fed funds rate, which is not tied to mortgage rates. That's one big misconception.
You want to add anything?
Well, no, I concur. I mean, he's spot on. That's exactly correct. The only indirect that might happen sometimes with the Feds is the cost of borrowed money, which does impact your business and my business because we lend money. The cost of borrowed money is indirectly affected somewhat with the Fed, but on a day in, day out basis, Andrew's 100% correct. It can be PPI, CPI, unemployment numbers. And right now, the market we're in today, any number can move the market immediately. Sure. It's not, typically you'll see a trend line where the market moves in a gradual motion for the most part. It hasn't been the case for the last couple of years.
Okay.
It's a knee jerk.
Right? Yes. Our market is forward thinking. We're already anticipating the Feds reducing the rate or increasing the Fed funds rate. And we're just looking at different employment reports and a bunch of data that comes at us.
Okay. So if, let's say that
there has nothing to do with an election year, whether it's spring, whether Santa Claus is coming to town, there's all these different, it doesn't have anything to do with that. You'd be surprised what people think where mortgage interest rates come from. It's mortgage-backed securities, MBS.
So we see rates fluctuate regularly during the day or during the week, right?
I tell people rates change 1 to 5 times every day the stock market is open.
Yeah. Okay.
That's my general and I also use the analogy the rates are like if you cornered a squirrel and you start going after the squirrel. You don't know, is it going to go left? Is it going to go right? It's just this scared little animal It just moves at the slightest,
And that's a good analogy, I think.
Yeah.
I'm gonna steal that.
Yes, you can have it.
That's a really good one. But the reality is, as Andrew pointed out, the mortgage-backed securities are pretty much bundled packages,
Sure.
and the institutions purchase them,
Okay.
not an individual per se. So the institutions are looking at forward projections on what they want to yield to be determined. So you put $50 million of mortgages together, you get an average yield. They're looking at that yield, and on any given moment, depending on what the market projects to happen, whether it's going to recession or whatever, that determines what they're willing to pay.
Okay.
And that comes right back to you and I, where we're being told, hey, today it's going to cost you this much more. And sometimes it's counterintuitive to what you see happening in the market. You're saying, oh, we're going to have a good day, inflation's down, or whatever, and all of a sudden the market goes the other direction.
Mm-hmm.
That's because there's some other technicals going on in the back end.
Okay.
Exactly. Yeah.
So when it comes to Federal Reserve changing their interest rates, how quickly do consumers see that with mortgage rates? It sounds like what you said, that it may
They've already built it in.
It's already been done before the Fed does anything.
Absolutely.
Okay.
They look at the percentage of the Fed doing this, and then we base, the larger the percentage, that's what we base the rates off of.
Sure.
So it's already built in. You're not going to see the Fed release their rate, and then all of a sudden our rates go in the same direction. It's already done.
Yeah.
So
built in.
right now,
if I can piggyback
Sure.
on that, what he's saying is true in the sense that it's built in the future, but you also see where the markets are making projections of what's going to be built in, and then they find out. We get high PPI and high CPI numbers last week,
Sure.
and all of a sudden the rates are jumping 25, 30 bips because the built-in projection's wrong. It's just like you said, the squirrel. I mean, the same thing with everybody telling you. You get all the experts telling you every day, oh, it's going to go this way, it's going to go that way. The Fed's going to have 6 rate cuts. Well, we'd be lucky if they get 3 at this point, right?
Correct.
And so, you'll once the reality sets in, what's going to happen, which is really no one knows. We're just projecting it.
It really is amazing how they predict the unemployment, and then the actual unemployment comes out, and they're so far off. I mean, I want that job.
Yeah. Oh yeah.
It's like a weatherman. You can always be wrong.
I was going to say exactly like a weatherman.
Then 2 months later, the revision comes out.
Yeah.
And it's the complete opposite.
Yeah.
So
the weatherman doesn't come on and go, oh, I know I said it was going to rain yesterday, and it didn't. I'm sorry.
So for the last couple of years, a lot of buyers and a lot of people said they're waiting to buy a house until rates drop. And in that time, and in our local market, we've seen anywhere from 6 to 11% annual increase in the average price of a house. So given this rate of appreciation, and I know I'm asking you to do math in your head, which is probably a tough one, but just give me an idea, like how far would interest rates have to drop? Considering our average home sale is in the $450,000 range, like how much would that rate have to drop based on a $450,000 sales price for that interest rate
to
offset?
Yeah, I would say a couple of percent.
Offset from where we were?
Anywhere. So we're going 10%
you're
a
saying
year. So if we're at 450 today and they're going to wait
about 2.5%.
Yeah.
So it's a pretty significant drop. So if we drop 2.5%, I mean, that's going to be a pretty desperate economy that we're in, pretty slow chugging along.
Right.
Yeah. Possibly the other side of the coin is if that happens, you haven't purchased a home where the rates right now, we're in the 6s right now, which is a reasonable rate. I mean, historically, if you look at the trend lines, I remember the 90s, average rate was 8.5. And, and you go back before that, early 90s, I mean,
the real old dogs will tell you, oh, the fixed was 15 and the arms were 13. And I wasn't in it that long ago.
Well, when I started, we were doing arms in the 9s.
Yeah.
So,
well, when I started in 05, we were solidly in the 6s, and I don't remember much deviation other than 2021 and 2022.
Yeah.
So I think the biggest challenge that people are facing right now is the demand for the housing, right? And it keeps pushing up despite interest rates going up, which brings me to my next question. It's based off the last few years, what we've been experiencing with buyer demand, your experience, your combined 60 plus years experience in the business. Does it seem that waiting is a solid strategy and is working?
100% not a good strategy at all. If you see the house and you can qualify for it, look, we're not going to put anybody in a house they can't afford. Right. We're not in the foreclosure business. We're in the collect monthly payment business.
Sure.
So if you can afford it, we're going to let you know, get it. And then if all the projections are right in the next whatever down the road, we're going to see some rate decreases, and then we'll have to refinance people.
Sure. What do they say? marry the house, date the rate.
Yeah.
You've heard people say that. But reality is that, and Andrew and I probably see this the same way. Your best option is if you get into a house now, in a year and a half from now, or 2.5 years, whenever the rate's down, you can refinance and lower that payment down. When that happens, this market is going to go gaga. I mean, it's going to be crazy out there with people trying to buy like it was 2 years ago.
So that kind of leads me into my next question for people is, so let's say rates do come down. I mean, what do you guys think the real estate market is going to do?
Well, 2 years ago, it was nuts. You went to write an offer on the house. It came on the market on Friday. By Saturday, there were 10 offers, 50,000 overvalued, waiving appraisal and contingencies.
Sure.
And that's what you're looking at again.
So you think that when the rates do come down, buyers are going to jump back in, the ones that are still there?
Yeah, well, they're there
jump back
now.
into the market.
They're there now, but they're going to come out in force.
Sure.
Well, you saw the difference from 8% to 6%. All of a sudden, your phone starts ringing.
Right.
Oh wow, the rate's coming down.
Right.
Well, if the rate's hitting the low to mid fives, you're going to have enough sellers in the 2 to 3% range that are in a position where they need to sell, who are holding on with that rate, who are going to say, you know what, it might go to 4.5. I doubt it.
Sure.
But it's not going to go down much lower than that. We might as well sell our house. So you should see more inventory come onto the market, but the buyers are going to exceed that inventory probably 10 to 1.
Sure. And they have been, to be honest with you, really since about 2016, we've been seeing swings in the market, usually the spring and summer market where there are multiple offers. Now we're just getting more constant, regular pressure. Then it's kind of like a seasonal thing. So I can see it, and we see it right now. So I guess it brings me kind of the last questions. We can wrap this up in the last couple minutes here. Is what are some things that buyers can do to buy a house today to help them lower their mortgage payment? Like what are their options?
Pay points.
Okay, so buy down their interest rate?
Absolutely. Paying a point right now is definitely one of the ways to go, because your break even is usually around 3 years. So paying points is a big deal. We got the buy down. You can buy down the rate 1%. You could buy it down 2%. These are seller funded things, but the seller's willing to contribute.
So the buyer can use their own funds to buy down the interest rate.
Yes.
Then they could also turn to the seller for a concession and say, hey, can you help me lower the interest rate to get a better payment?
By getting closing out. Yeah.
Okay.
And one of the misconceptions that buyers have is they think that if they have an extra $10,000, they think putting it down on the mortgage is going to substantially drop the payment, and it's probably maybe $40, $50 a month. But reality is that $10,000, and depending on the sales price, obviously, or the loan amount, can substantially drop.
So it'd be better to buy a point.
Absolutely.
Or 2 points.
Okay.
Yeah, every 1,000 towards loan amount is about $6 a month. It's a lot less than people think.
Yeah.
I think it's $20, $25, but it's only every 1,000 $6 a month.
It's nothing.
Okay. All right, cool. Well, gentlemen, I just want to say thank you for your time today.
Sure.
And if you have any questions about the content of this video, or you'd like to learn more, reach out to us at any time. You can call or text Anthony at 443-324-5339 or Andrew at 410-446-1796. You're always welcome to call or text me at 410-777-5848, or you can also drop a comment below and we'll answer for you. Thanks for tuning in. Have a great day.